trying to set up your own fund, I think the first thing is they need to understand your track record. It is extremely difficult to start a fund from scratch if you had no track record in investing. And quite often what happens is you mix a group of people that have some track record and others that were entrepreneurs and therefore they were operators and know how to grow companies. In our case, that's what we did. So we had Christina and partially myself, although on a much smaller scale, that were entrepreneurs. And then both myself and Ricardo, which had been on the advisory side, on the investment side for a long time as well, and were more experienced in terms of age. And so the first thing is, do these guys know how to invest? That's shown by your track record, for sure. And then the second thing is, do they have deal flow? I mean, do they know where to find the deals? Because ultimately, the game of VC is a game of access. Do you have access to many companies? And in particular, do you have access to the best companies? Can you invest? Will you be the chosen investor by those very good teams of entrepreneurs that quite often can choose between different investors? And then the third thing I think that was crucial for us was, does this team have the international reach to make follow-on rounds happen? Because let's not forget, it's not the game only starts when you invest. This is VC is a game of layers of capital. You start with pre-seed and then seed, Series A, and so on and so on. And you're not going to do the whole thing until the end. Most likely, very few VCs can or want to do that. So particularly when you are in a smaller ecosystem, you are essentially a supplier of deal flow to other more advanced ecosystems where there's more capital. Ultimately, Europe has been, a supplier of deal flow to Silicon Valley, for example, and within Europe, smaller countries end up, supplying deal flow to more advanced ecosystems like Berlin and London. And so you need to have that sort of international reach. You need to have those connections. And VC is a small industry. It's a high impact industry in the world, but it's very small. There's a few people only, a few thousand people that are in the industry across the globe. And so you need to know them, basically, and they need to know you. Otherwise, they will not trust you. They will not look at your deals. They will not think of you as a potential co-investment partner. So those three things are fundamental: your track record, your ability to source deals, and your ability to co-invest with other funds across the world.
That's very interesting to hear. Very interesting, Stephan. Now I'd love to go a bit off script here and pick your brains on how you view the European VC industry, and just for our listeners to understand why I'm saying that I just have to do this. It's of course because you have an experience as being a former advisor to the European Commission of Science and Innovation. You're also a past chairman of the European Venture Finance Network. You're a board member of the European Venture Capital Club and Private Equity Association. You've also been a board member of the International Venture Club. And I must say, this is quite a track record. So I really just can't resist but dive into the topic of fundraising at a European level. Do you think European investors are less interested in deploying capital into VC funds versus investors from other regions? Or how do you see our ecosystem evolving?
Yes, I mean, if you look at the European sort of limited partners landscape, which are the people that invest in funds, it's a bit grim, quite frankly. I mean, of course, if you are a very well-known blue chip fund from the US sitting in London, or with a huge track record for decades or a couple of decades across Europe, that's maybe fine. But the truth is, the vast majority of VCs struggle to raise funds. And this is not because there's lack of deal flow, right? Because I think that one of the issues that sometimes potential investors have is, but is Europe competitive? And again, it's not a problem with deal flow or not a problem with capacity of Europe from European scientists and engineers and entrepreneurs to come up with amazing, life-changing and global dominating companies. We can do that for sure. So there's enough demand for the capital. The problem is that the vast majority of potential LPs just refuse to invest in venture capital and are very wary of the asset class. Some of them because they lived through past disasters such as the dot-com bust back in the day, but that was 20 years ago. Most of them are not around anymore. And some of them just because they are quite frankly forbidden from investing in this asset class. And they will only consider the very traditional, equities and bonds and those kind of things, and eventually maybe a little bit of private equity because it's already very, very established. And VC always gets left behind. And I think that a big part of the work that I tried to do when I was at those different institutions, and namely when I was close to the Commissioner for Science and Innovation, Carlos Moedas, was actually coming up with ideas and projects that could eventually make institutional and private investors in Europe consider VC as an attractive asset class. But I think, quite frankly, we have a long way to go, a really long way to go. I mean, we see it in the US, the way people look at innovation and the amount of capital that they also have available is probably larger. The history and the track record of VC is larger and probably much better. And so what we face constantly in Europe is, and what we faced also in our own fundraising was, I don't invest in VC. Or secondly, if I invest in VC, I would invest in Silicon Valley, even European investors, which is fine. I mean, but, just try to invest in the best VCs in the Valley, and you'll see that it's not possible, actually. And number three, quite often they will say, well, I'll not invest in first-time teams. And you say, well, we're not a first-time team. I mean, we've done all these investments. Well, but, show me the first fund or the second fund or the third fund, and then we'll speak again. And I think that's difficult because size matters in venture capital, and particularly in the current status of the market, even if there's a bit of a downturn now. The truth is the rounds are getting bigger and bigger, and small funds just can't make it. You need to have at least 50 to 100 million in the management to actually be a reasonable player that has some access and has the ability to do follow-on investments that are material and that protect your equity stakes in your companies. Otherwise, you are not part of the game and you get diluted, and your results will be negligible and bad for your investors. So I think that the industry needs to grow. I think that there's a lot of policy that should change across Europe, both individually in countries, but also at the European Union level, that would incentivize the private sector to invest in financial intermediaries that can then choose the companies that can become global success cases. And I think not enough has been done in that. And then quite often what happens is there's another public program or another public entity that ends up investing and creating, a public program that invests in funds. But quite often there's lots of little details that don't enable these fund managers to grow. There are a lot of red tape and a lot of reporting, which is all done in very good intention, but actually doesn't let the industry grow. And I think that we need to grow the industry significantly to become comparable, at least in terms of assets under management and quality, to our US counterparts. Because actually, if you have more assets under management, you are able to recruit a better team, you're able to support better your companies, and you're able to supply them with capital in larger quantities, which hopefully will be a good thing for the sort of the plan of global domination of that specific vertical. So we do have a lot to learn yet, and I think sometimes we get a little bit confused on details and on trying to optimize policy to a point where it's actually detrimental to the fund managers, and in the end, it's detrimental to the innovation industry in Europe.
Yeah. So this grim situation, as you described, is basically, as I perceive, a result of a lack of investment capacity in Europe, but also higher risk aversion, whether formal or informal. And I would love to pick your brain, Stephan, here, and maybe just on key highlights or key policy agendas. How can European VCs push for policy developments allowing for more capital to be deployed into European capital markets? And my main interest here is, what do we as Europeans need to learn from other regions, but also what should we or must we design from scratch?
Well, solutions are not easy, of course, but there's a lot of institutional investors that cannot invest in this asset class. I think that across countries there should be, and at an European level, we should bring down those barriers, where essentially it's forbidden for certain pension funds and so on to invest in what is considered an asset class. And for the country, I think there should be, at an individual country level and also at an European level, an incentive scheme provided so that those fund managers, those funds of funds, let's put it this way, can and would invest in VCs. Now, we're always talking about minuscule percentages of their assets under management. But if you have 1% of the pension funds in Europe invested in VC, that would be a tremendous revolution. Yeah. So, because the vast majority invest zero. So we're not saying, look, we should get all the pension funds to invest 20% of their assets in VC. No, not at all, right? That would probably be way too much, although in the US, lots of pension funds actually do that, and very successful ones. But the fact that they are not incentivized, that there's no tax advantage, and that there's actually barriers, it's a problem. And then when you look at individual investors, some countries have already done some efforts in having individual investors invest in technology or in startups, but very rarely in the financial intermediaries. So what actually happens a lot of times is that these individual investors become these sort of tourist angel investors that have no idea what they're doing, and basically they're investing in the wrong companies and sort of basically wasting money, their own money and the state's money, which quite often it's a subsidy from the state. And so, of course, it's in our own interest to say this, but it would be smarter if those people that have savings would have a tax break to invest in professional investors that could then theoretically, hopefully, take better decisions in terms of investment decisions. And we haven't seen that happen yet. And again, the easy solution is always for the state, the European state or the local state, to come up with another scheme, sometimes for financial intermediaries, but quite often to invest directly, because it's considered that it's faster and so on. And what we should really do is not stop the public sector from investing in VC firms, because if it wasn't for the public sector across Europe, particularly the EIF, there would be no VC in Europe. But we really need to sort of reach out to the private sector, because that's where the real big capital is. And just a tiny bit of that capital would change the outlook of Europe as a continent, as a powerful force in technology in the 21st century. And as we all know, the game, the macroeconomic and the geopolitical game is being played on the technology level. And so Europe should not and cannot be left behind.
Yeah, thank you for the super insightful and very objective and actionable suggestion and highlights. We've spoken a lot about the European VC ecosystem. However, I would like to zoom back into Indico right now. In 2019, you invested a total of 22 million euros in 10 companies and helped create more than 600 jobs. That's really amazing. And from what I was able to gather, a significant part of Indico's deal flow was coming from Spanish entrepreneurs. And in March, if I'm not mistaken, you announced the opening of a Madrid office. This means that you guys are now investing across Iberia, so Portugal and Spain, rather than focusing just in Portugal. Can you elaborate a bit on this decision and its implications?
Yes. So I think that what happened was that we did invest 22 million. Our companies altogether have already raised more than 250 million. So we're very fortunate to have, investors from all over the world that are doing the follow-on rounds in our companies. And because lots of those investors have their own portfolio companies, a lot of those portfolio companies started reaching out to us, sometimes through those funds, and saying, look, would you consider investing in us as well? And namely from Spain, from all over Europe, but also from Spain. And Spain is a very interesting market. It's a much bigger market than Portugal. It's also a much more competitive market, in the sense that there's lots of very good funds, but there's also more people and more ideas. It's comparable in terms of quality. I cannot say that I see better or worse deal flow from Spain, but there's just more companies and more funds. And so we ended up deciding that the time was right to sort of look at Spanish entrepreneurs in more detail. And one of our previous colleagues from Caixa had moved to Madrid for personal reasons, and we like to sort of work with people that we trust and that have known for a long time, because Indico is to a certain extent, it's like a family, a small family of people that trust each other and that have worked together for many years. And so we decided to re-engage with Rui and bring him back into the team and basically essentially open up the Madrid office. Of course, the Madrid office suddenly became his home because the pandemic